If you are an investor in Standard Chartered or the broader banking sector, you probably saw the headline that hit the wires today. It is the kind of headline that makes you sit up straight and check your portfolio app immediately. A massive US $2.7 billion lawsuit. Not a million. Billion. Greenlit by a UK court, dredging up the ghosts of the 1MDB scandal. That is a terrifying number, and it represents a potential hit that could wipe out a significant chunk of quarterly earnings. But if you strip away the shock value of that US 2.7 billion debt figure and look at what the rest of the Singapore market did today, you will see a completely different story. While that dark cloud formed over one banking giant, the Straits Times Index, our local barometer, actually climbed. It pushed up 0.4% to close at 4,501.56. Why? Because if you look past the legal drama, there is a hidden engine of growth in sectors we haven't paid enough attention to, specifically in healthcare, and a very specific defensive maneuvering happening in our REITs. The headlines scream lawsuit, but the smart money is whispering resilience. I'm Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the clickbait, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context, so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, point-by-point analysis through the daily SGX Market Digest for November 27, 2025. We are going to dissect the healthcare boom, the truth about REIT refinancing, and the real risk of that banking lawsuit. Let's start with the big picture before we zoom in. The Straits Times Index closing at 4,501.56 is significant. We are seeing a 16-point gain that mirrors the optimism we are seeing on Wall Street. This is crucial for us as Singaporean investors because it confirms that the risk-on sentiment is global. When Wall Street rallies, the STI often drafts behind it, but usually with a lower beta, meaning we don't go up as much, but we don't crash as hard. However, today's move was driven by something specific, a rotation into quality. Investors are ignoring the noise and buying earnings. Let's look at our first major case study of the day, IHH Healthcare. The headline here is that profits are up 15% to $193.66 million for the third quarter. Now, on the surface, that sounds great. But as analytical investors, we need to ask why, and is it sustainable? To understand this, we need to look at the concept of operating leverage in hospitals. Hospitals are high fixed cost businesses. You have to pay for the MRI machines, the specialist doctors, and the building maintenance, whether you have one patient or 100. Once you cover those fixed costs, every additional patient contributes significantly to the bottom line. That is operating leverage. IHH is seeing higher patient numbers, specifically from medical tourists. For those of you new to the sector, medical tourism is a high-margin segment. These aren't patients coming in for a subsidized flu jab at a polyclinic. These are international patients flying into Singapore or utilizing IHH's overseas networks for complex, high-value surgeries, oncology, orthopedics, cardiology. When we see a 15% jump in profit, it tells us that the patient volume knob has been turned up. But here is the Iggy perspective. In a shaky global economy, where we are worried about inflation and supply chains, healthcare is defensive. People can delay buying a new car. They cannot delay heart surgery. This resilience is why IHH is firing on all cylinders. It is not just a growth story, it is a safety story. For us holding this in our SRS accounts, this is exactly the kind of boring but beautiful compounding we want. The risk here? Valuation. Everyone knows healthcare is a safe haven, so the price usually reflects that. The question isn't, is the company good? It's, is the stock too expensive? We will get to that in the recommendation section. Next, let's pivot to a sector that is the bread and butter of many Singaporean dividend investors, REITs, specifically Keppel REIT. The news is that Keppel REIT secured over $400 million in new loan facilities. Now, I often get emails from viewers asking, Iggy, why are they borrowing more money? Is the REIT in trouble? Let's clarify a key concept here: capital management and refinancing. Unlike a normal company like Singtel or generic manufacturing firms, REITs are required by law to pay out 90% of their taxable income to us as unit holders to enjoy tax transparency. That means they cannot retain cash to pay off old debts. They must borrow new money to pay off old money. It is a perpetual cycle. So securing $400 million is standard operating procedure. It is not a sign of distress, it is a sign of housekeeping. However, the analysis cannot stop there. The most critical metric we need to think about today is the cost of debt. In 2020 or 2021, a REIT could borrow at roughly 2% or 3%. Today, in late 2025, refinancing that debt means moving from a cheap loan to a more expensive loan. Even if Keppel REIT is well managed, this new $400 million facility almost certainly comes with a higher interest rate than the debt it is replacing, or the general average from a few years ago. From my perspective, this is the silent killer of DPU. If your rental income goes up by 2%, but your interest expense goes up by 4%, your distribution per unit drops. This move by Keppel is defensive. They are locking in liquidity so they don't get caught short. But we need to watch their next earnings report like a hawk. We need to look specifically at the all-in interest rate. If that number is creeping up too fast, it will eat into your dividends. So don't celebrate the loan, calculate the cost. Now we have to address the elephant in the room. The headline that caused the most anxiety today: Standard Chartered. A UK court has allowed a US $2.7 billion lawsuit regarding the 1MDB scandal to proceed. Let's break down what headline risk actually means. Headline risk is when a stock price drops, not because the business has stopped making money, but because the sentiment around the business has turned toxic due to news. The 1MDB scandal is complex, involving sovereign wealth funds, alleged misappropriation, and years of legal battles. Standard Chartered is being accused of alleged links. Here is the analytical breakdown. US $2.7 billion is a massive potential liability, even for a bank the size of Standard Chartered. That hurts. It impacts capital adequacy ratios, which are the buffers banks must hold by law. If they have to pay this fine or settlement, that is capital that cannot be used for dividends or buybacks. But there is a second layer to this: distraction. When a bank is fighting a multi-jurisdictional lawsuit, management's attention is divided. Instead of focusing entirely on growing the wealth management division in Asia, they are in meetings with lawyers. Legal battles are expensive, yes, but they are also time-consuming. My take for Singapore investors: we love our banks. DBS, OCBC, UOB are the holy trinity. Standard Chartered often sits in portfolios as a way to get exposure to emerging markets. But this lawsuit is a dark cloud. Unlike a bad earnings quarter which can be fixed in 3 months, a lawsuit like this can drag on for years. It creates an overhang on the stock price. Even if the bank performs well, the stock might not rise because new investors are scared of the legal ruling. This is what we call dead money. Money that sits there and does nothing because of external fears. Before we get to the final assessment, we have to look at the broader context of the market today, because nothing happens in a vacuum. Two things stand out in our peripheral vision. First, Bitcoin surging past US $90,000. Second, financial scam complaints hitting a 20-year high. These two things are related. When we see assets like Bitcoin hitting all-time highs, it triggers FOMO, fear of missing out. It creates a risk-on psychology where investors feel like they are losing out if they aren't making 50% returns overnight. This is dangerous. It makes you sloppy with your due diligence. It makes you chase yields that don't exist. And that is exactly why scams are at a 20-year high. Scammers prey on that greed. They know you are looking for the next Bitcoin. As your analyst, I have to be the buzzkill here. High returns always come with high risk. There is no free lunch. If you are seeing a guaranteed 10% monthly return, run the other way. The surge in crypto is interesting and it shows liquidity is out there, but do not let it dictate your long-term strategy for your retirement funds. So let's pull this all together. What is Iggy's assessment of the market right now? Let's look at what's working. The Singapore market is showing incredible resilience. The STI breaking 4,500 is a psychological win. The healthcare sector, led by IHH, is proving that quality earnings and essential services are the place to be. The balance sheets of our major blue chips are strong. If you are holding quality, you are sleeping well. Now, what's not working? The banking sector has a new headache. The legal risk for Standard Chartered is real and unquantifiable right now. For REITs, while they are managing the cost of debt, is a friction point that isn't going away. We are also seeing a dangerous rise in speculative behavior in the crypto markets that could bleed over and burn retail investors. So what is the valuation picture? IHH Healthcare is trading at a premium, but given a 15% growth rate, that premium is justified. It's what we call growth at a reasonable price. Standard Chartered, on the other hand, might look cheap on a price-to-book basis, but it is cheap for a reason. It's a value trap until the legal smoke clears. Here is my final recommendation for you. For existing unit holders and shareholders, if you own IHH Healthcare, hold. In fact, sit tight and enjoy the ride. The thesis is playing out perfectly. The return of medical tourism is a multi-year tailwind. If you own Keppel REIT, hold, but watch the next dividend declaration. If the DPU drops by more than 3 to 4% due to interest costs, we may need to reassess. If you own Standard Chartered, this is tough. If you have a small position, you might ride it out. But if it is a large part of your portfolio, you are facing years of uncertainty. I would not blame you for trimming the position to sleep better at night. For new buyers, I would be a buyer of IHH Healthcare on any pullbacks. If the general market dips and drags IHH down with it, that is your entry point. For Standard Chartered, wait. The risk reward simply isn't there. Why take on $1 billion lawsuit risk when you can buy DBS or OCBC, which are clean? I'd wait for the legal situation to resolve, even if it means paying a higher price later. Certainty is worth paying for. And regarding the crypto surge, leave the chasing to the cowboys. If you must play, keep it to less than 5% of your portfolio. Money you are willing to lose. This market is tricky. It has split personalities, record highs in some places, record lawsuits in others. You need to stay disciplined. If you found this breakdown valuable and want to keep navigating the SGX with this level of depth, consider becoming a free or paid subscriber to my Substack. We go even deeper into the numbers there, providing the charts and data tables I can't read out here. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Your support keeps the lights on and the analysis unbiased. Thanks for watching. Stay safe out there, avoid the scams, and I'll see you in the next analysis.